Hello, my lovely FRM friends, and welcome to our reading on mortgages and mortgage-backed securities. Very interesting reading. We're gonna also look at our calculator functionality to allow us to calculate the monthly payment on a mortgage. We'll also look at different structures that attempt to protect us from the all important prepayment risk and reinvestment risk when dealing with mortgages. So let's get started. Okay, so the first slide is nice and gentle with us. It just defines what a mortgage is. Well, a mortgage is a loan. Definitely it is a loan. And what kind of loan is it? Well, it's a loan secured by property. That's why we call it a mortgage. And the property acts as the collateral. That's why when we borrow via a mortgage, rates tend to be very, very low, and they're much lower than if you just obtained a consumer loan. And at the moment, with all the QE in the world and all the loose monetary policy, it is not uncommon to be able to borrow at 1% if you're a high quality borrower with a large deposit. Okay, if you're looking at the mortgage. Secondly, we're going to look at the lien status, and that's basically looking at the seniority of your mortgage. So if there were other loans secured on the property, are we talking about a first or second mortgage? Of course, a first mortgage will have priority in the event of default, and a second mortgage lender will only get paid if the first mortgage lender has been repaid in full. Then, of course, we've got the original loan term. So it's not uncommon for people to borrow for 15, 20, 25, or 30 years loan terms. Now, of course, that is only the nominal life of the mortgage. And as we said, there will be a very real risk of prepaying or refinancing this mortgage before its stated maturity. Now, in book one, in foundations, we did mention different types of mortgage structures. Historically speaking, let's say in the 60s and 70s America, people would just go to their local bank and obtain a fixed rate mortgage, say for 30 years. And, that was before securitizations. The lender will really care about your credit quality. They'll originate the mortgage, they'll hold the mortgage onto their balance sheet. And of course, you, the borrower, would be signing up to a fully amortizing loans. In other words, when you retire, you will own the property outright. And of course, the rate would be fixed. So there would be no interest rate risk from your perspective. Now, of course, with the advent of financial engineering and securitization and all those new things that came in the, let's say, the 90s, the 80s, the 90s, we now also have, and of course this was mentioned in the credit crisis reading, we now have the so-called 2-28 ARM, which basically stands for adjustable rate mortgage. So it means that we sign up to a 2-year teaser rate, which tends to be very, very low. But at the end of this period, then we are going to move to perhaps the variable rate for the bank for the remaining 28 years of this 30-year mortgage. And the key thing here is that the variable rate of the bank may be treble the amount that you were originally paying. So normally this would become unaffordable for a lot of borrowers. So the idea behind the ARM